Welcome to our presentation. My name is Steve Kuna and I'm the founding advisor of the Select Retirement Plan program. In the next 30 minutes, I'm going to provide you with an overview of the retirement plan landscape, some of the challenges facing retirement plan sponsors, and how our program can dramatically reduce and in some cases eliminate much of the administrative hassles and fiduciary landmines associated with running a 401k or a 403b plan. So for a quick background on me, I'm a 26-year retirement plan focused advisor. For many years, my clients were referring to me as their retirement CFO, so we decided to trademark the term. But I do focus on corporate retirement plan design and service. I've been named a top 100 plan advisor for several years running by Plan Advisor magazine and the Financial Times, as well as named a top 300 advisor by the 401k Wire. And not long ago, we were featured on Wall Street Today, which was aired on several of the business news stations, as we were discussing some of our unique retirement plan solutions and how we're trying to reverse the trend of low savings rates in this country. It's actually a snapshot of us on the set of Wall Street Today, which is actually filmed at a location overlooking Times Square, a great venue for a television program. So for an overview here, this is data from the National Association of Plan Advisors, and it paints a grim picture. And it shows that most advisors in this business, to the tune of over 90%, have very little experience when it comes to managing corporate retirement plans. In fact, the vast majority service a retirement plan as an accommodation to the business owner who they may be working with in a personal financial planning or a wealth management capacity. And it's this lack of experience and technical knowledge, in my opinion, that is exposing these businesses to unnecessary fiduciary liability. So I'm going to show you today how we're protecting these companies and who we actually call retirement plan sponsors. So a quick snapshot here shows that there are over 600,000 401k plans in America today. There are over 300,000 registered advisors in the marketplace. And the average advisor's experience is as follows. 50% of advisors that do manage a retirement plan manage only one single retirement plan. 25% of advisors manage only 3. 5% of advisors manage 5 plans, and less than 2% of advisors actually manage more than 10 plans. So it tells us that very few are actively involved in this space. Many of my clients over the last few years have been experiencing concerns about the increased number of retirement plan audits, ERISA-related lawsuits, and they've been reading about them. And so how big is this problem? Well, the government statistics are always a bit outdated, but there is some, here's some of the most recent information we found from the IRS and the DOL website, as well as federal court systems. So in terms of risk to plan sponsors and some stats, the vast majority of lawsuits and regulatory actions involve failures in administration, not actually around the plan investment results or oversight. A little shy of 1,500 applications for the voluntary fiduciary correction program, 22,000 applications for delinquent filer volunteer compliance program, over 2,000 civil investigations. 67+% of those resulted in a payment or other corrective action. EBSA restored over $777 million to employee benefit plans, participants, and their beneficiaries. There were over 300 criminal investigations. 96 folks were indicted, including plan officials, corporate officers, service providers for offenses related to employee benefit plans. So they, along with plaintiffs' attorneys, are moving down market to smaller plans. When employers realize they've conducted a plan-related administrative error, the IRS allows them to self-report the problem via the voluntary correction program. Of course, this is only after paying the appropriate fee. But here are the top 10 reasons employers are requesting these corrections. First of all, there's failure to amend for tax law changes, incorrect definition of compensation, failure to include eligible employee or exclude ineligible employees from the plan, loan-related errors, impermissible in-service withdrawals, required minimum distribution errors, employer eligibility failure, ADP and ACP failure not corrected in a timely fashion, failure to provide minimum top-heavy benefits, and of course exceeding maximum contribution limits to the plan. We're going to show you in a little bit how we help our clients avoid many of these issues. So let's talk about the definition of a fiduciary, because the fiduciary is turned into the dirty F word, as they say, in our industry. So who's identified as a fiduciary and why should you care? Well, basically anybody that's considered legally liable to make decisions in the best interest of another party. That can include the plan trustee, plan administrator representative, which could be a corporate officer or a partner of the company, any authorized signers, any investment or plan committee members, anyone who's involved in plan level decisions. Some companies, maybe you don't have a formal plan committee, so who sits in on the plan review meetings? Could be a president, a CEO, CFO, director of finance, payroll admin, HR directors, sales managers, office managers, chief bottle washer, anybody. Let's just say you're not even doing a review. Well, then the question is, who actually signs the 5500 tax filing? Surprise. It's probably you. You're a fiduciary. And I call it a thankless job with absolutely no upside. So it all comes down to the plan administrator. Now you might be saying, but I'm not the plan trustee. We use a corporate trustee with the big bank or big fund company. Well, you think you're off the hook, but that's not the case. Pull out your plan adoption agreement. See on page 2 or 3 of the document who is listed as the plan administrator. Almost 100% of the cases, your company's name is listed as the administrator. You still don't believe us? You can always go to the ERISA.gov website and look up your plan's 5500 filing. See who's listed as the contact person at your company. When the DOL sends their notification of plan audit letter, who will they address it to? You guessed it. It's going to be you. You become the face of the retirement plan to the Department of Labor and the IRS. So who is the fiduciary on your plan? Again, I told you how you can look it up. This is a snapshot of a 5500 filing, and you can see normally that under name of plan, you'll see the company name, this plan sponsor. It'll identify who the plan administrator is, and in the majority of cases, underneath the little red arrow, you'll see the administrator is same as plan sponsor, essentially your company. And then down below, it's going to be your name or somebody from your organization signing on the dotted line, attesting to the accuracy of that 5500 filing. Wouldn't it be nice? Wouldn't you prefer if you could list somebody other than you, the employer, as the plan administrator? Well, we have a little bit more for you on that in a few minutes. So let's talk a little bit about the true cost of running a retirement plan. First, I'm going to review the obvious costs that I'm sure you're aware of, and then we'll discuss what we call the hidden costs that may be less apparent. So in terms of the average typical things that most employers are aware of, obviously you have the employer matching or profit sharing contributions. You've got mutual fund fees, advisor or consultant fees, record keeping fees, fidelity bond premiums, custodial fees, fiduciary insurance premiums if you have that kind of coverage in force, transaction fees, distribution fees, administrative fees, full or limited scope audit fees. I get it. Does your head hurt yet? There's a lot of different fees, and these are the obvious ones. But let's talk about what we know, or what we call the hidden fees. We're talking about the costs of administrative staff hours. And we find through studies that the average 401k plan takes over 100 administrative staff hours per year to operate, not including committee meeting times and the time required for an IRS audit or a limited scope audit. So this is just for the day-to-day ongoing administrative tasks required of the plan. We've created a handy-dandy calculator to help illustrate what these hidden costs may be for your company. So ask yourself, how many members are on your plan committee? What is their estimated annual salary? How often do you conduct a plan review? Annually or semi-annually, quarterly? What's the estimated annual salary of the administrative person that does most of the day-to-day work? And then also, who's handling the annual limited scope audit, and who would deal with an IRS or a Department of Labor audit? This is going to help calculate the total staff hours and cost to your company for running your plan. So you can see on our little spreadsheet here, we made an assumption that, and this is actually based on one of our clients. There were 5 members of their committee. The average salary of the folks on the committee is $100,000 per year. They did 2 meetings a year. Those meetings lasted approximately 2 hours. So they were spending about $1,000 in man-hour time to sit around a table deliberating over the investment options inside the 401k plan. They had an administrative staff person earning $60,000 a year that was responsible for the day-to-day activity on the plan, and that was costing around $3,000 per year. They were paying a local pension audit company $10,000 per year for their plan audit. We've seen these range anywhere from $10,000 to $15,000 per year. And we look at the difference of what the costs are in our program at $6,000 per year. And so the difference, we consider that an excess fee. But that says that right now on this plan, there is over $8,000 worth of hidden costs. And these are in addition to all the typical costs that we're already well aware of. So let me quickly summarize here. So it's very clear that most advisors are not true retirement plan specialists. There's more risk than ever from ERISA-based civil litigation, DOL and IRS audits, fees, fines, and corrective actions. And your company, your owners, and your staff are unwittingly exposed to this fiduciary risk and liability. And now we know that you're paying hidden man-hour related costs that you probably didn't think about before that are above and beyond the typical 401k plan fees. So ask yourself, if you could avoid the risk and administrative hassles of sponsoring a company retirement plan to the maximum extent allowed by law, still have control of all your plan provisions, and almost eliminate the hidden costs that we just shared, would you do it? I'll let you think about that for a second. So if you'd answered yes to my previous question, you may want to take advantage of this next generation retirement plan solution. The Select Retirement Plans are a family of 401k and 403b plans designed to help employers outsource the risk and administrative burdens of running a retirement plan so they can focus their energy on, guess what, running their businesses. We have 4 options available. The first one is our Select EM 401k plan. This is our small market product for startup plans all the way up to $1 to $2 million. Next, we have our Select 401k plan, which is our flagship program, most popular, accommodates plans between $1 and $2 million and up. Our Select MD 401k plan is exclusively for our for-profit medical practices. And finally, our Select 403b plan is available to our nonprofit clients. The Select Retirement Plan program is known as an open MEP. So what is a MEP? Well, it stands for Multiple Employer Plan, and it's a concept that was actually devised over 70 years ago, initially for federal savings banks. It essentially allows multiple individual and unrelated employers to pool their plan assets together to leverage pricing power and to economically outsource an estimated 90% of plan-related tasks. Soon we're going to show you a list of employer administrative responsibilities prior to and then after adoption of our program. MEPs take advantage of a few simple concepts. First of all, there's safety in numbers. This is evident in nature with herds of animals and schools of fish, but it also applies to 401k plans. The next concept is achieving economies of scale when you leverage the purchasing power of many, buying in bulk, being able to get institutional pricing, and leveraging the power of the assets of many to negotiate the costs of services. So how does this apply to 401k plans? Check out this concept video for more details.
You want the best retirement plan for your employees and your company. But as a small business, you don't have the buying power that the largest companies have. But you can. It's called a multiple employer plan. You join your company's plan with those of other companies to form a much larger plan. By doing this, you get a simpler, safer, more cost-effective program with less effort. Here's how it works. Professional administrators oversee the plan and accept legal responsibility and accountability for doing so, which means your name comes off the legal documents. allowing you to outsource fiduciary responsibility and liability for the management of your plan. A group plan streamlines plan management with a single plan document. Plan administration and paperwork are dramatically minimized. That means you're left with a much smaller set of chores and responsibilities. You save time and labor, two of your most precious resources, so you can spend more of your time running your business. Your employees get the benefit of a high-quality retirement program complete with professional investment management and access to the most cost-effective investment options, normally only available to the largest companies. This doesn't mean you give up control of your plan as it currently exists. You still have the flexibility to set the provisions of your plan, including how much you contribute. Your advisor can spend less of their time on compliance and fiduciary issues and more time focused on helping you and your valued employees achieve your financial goals and retirement readiness. Let's sum all of this up. Less work, safer, cost-effective. It's that simple. We understand you have a lot of priorities, but this is important. So contact us today and let us show you how we can help you deliver a more successful retirement plan.
So how do we protect you? Well, first of all, our record keeper replaces your name with ours as the corporate discretionary trustee. Secondly, we replace your name as the plan administrator on your plan document. That means the IRS will call our back office instead of you in the event of a plan audit. We replace your administrative person with ours and do the 100+ hours of administrative tasks for you. We'll also replace your investment committee with ours as both a 338 and 321 investment fiduciary. If you choose to use one of our vetted plan auditors, we may be able to save you on your annual audit fees. Remember, we're buying in bulk and we have pre-negotiated rates. So how do we save you time? Well, first of all, you and your staff will no longer have to sit through investment committee meetings deliberating over Fund A versus Fund B while exposing yourself, your committee members, and your company to the associated liability. Remember, you're outsourcing that process to a 338 and a 321 investment fiduciary. Will handle the menu creation, the investment monitoring, and employee communication related to the investments. Seamless payroll integration is available. We may be able to work with your existing payroll provider. However, sometimes a payroll provider change is required. We can help you figure that out. But most importantly, your administrative staff will no longer have to process, well, you'll see. Most employers are shocked by the sheer magnitude of the tasks required to run a retirement plan. They may be actually processing all these items, or they've hired a service provider to do some of the tasks for them. But as the plan administrator, they're ultimately responsible for all the items being done correctly and within the required time frame. Now, for those forward-thinking employers who realize they could be paying their staff to help run their business rather than run their retirement plan, these are the only tasks that remain after an employer adopts a select retirement plan as their own. You'll note that 2 of the items listed above, including submitting ongoing payroll contributions and providing the year-end census data, can actually be outsourced to a payroll provider. And this leaves only the task of coordinating employee education meetings so that your employees can fully understand, appreciate, and hopefully participate in the plan. So how do we save you money in this program? How does this work? Well, retirement plan costs are primarily determined by 3 factors. The first one is total plan assets. Second one is average account balance. And the last is the total services that are provided. So a typical employer plan, for example, if you happen to have a $3.3 million 401k plan with 70 employees, it's individually priced, and we have very little pricing leverage. You have the assets that you have the average account balance, and we could take your plan out to bid, and we could approach multiple 401k providers in the marketplace, and they're each going to price that plan out based on this data. And we have, again, no leverage in that analysis. Now let's review our MEP pricing scenario. Because we're leveraging the assets of several plans together, our clients enjoy better pricing power with our record keeper and administrator. As the plan grows and as more employers adopt the program, we have even more pricing leverage with our record keepers. So how do we save money? Well, the total cost analysis shows that our MEP pricing averages about 20% less than a similar size individual plan. We have had clients save anywhere between 20 to 40% on plan costs, depending on the current structure of the program that they were in. If they were in an older legacy type product, if they hadn't benchmarked or monitored their fees in a number of years. Our full scope and limited scope audit fees are, in our experience, generally less than the national averages. We have seen numbers as low as 30 to 40% lower than what clients were paying. However, from a service standpoint, I think we provide significant value, because what you're getting here in a cost that's less than what you're likely paying right now, a third-party discretionary trustee, full 316 plan administration, removing your company's name from the plan document, and having our staff be responsible for the administrative responsibilities of the plan. Outsourcing all the investment monitoring services and liability associated. ERISA bonding is taken care of. You don't have to ever worry about renewing your ERISA bond or making sure it's an adequate amount of coverage. Fiduciary insurance is included. We also assist with rollover services for terminated and retiring employees. We also have what's called terminated participant administrative services. In fact, we structured the pricing in this program so that terminated employees pay their own administrative fees out of their own account. So you'll no longer be in a situation where you may be paying administrative fees for people that no longer work for your company. And then finally, we use only institutionally priced mutual funds that are zero revenue. They are the lowest cost option available in any of the funds that are in the marketplace. There are some mutual fund families out there that have over 19 different share classes or different pricing options. We always will use the absolute lowest cost option that's available. And again, passing on the savings to you. So the pricing is very flexible. You actually decide how all your fees are paid. They are deducted quarterly either from plan assets, or they can be set up on a direct bill or a combination. You may choose to have some of the fees paid for out of the plan and be invoiced for the difference. We don't care. It's completely up to you. Furthermore, fees are fully transparent. There are no commissions or transaction fees for buying or selling individual funds inside the plan. There are no conflicts of interest. And again, as I mentioned earlier, terminated participants pay their own administrative fees. This is the organizational chart of our program. On the left, our firm acts as the local advisory firm providing the overall plan oversight, interpreting the investment monitoring process, providing the participant support services, onboarding of plans, and working with the plan committee. Our record-keeping partner on the right, Pentegra, serves as the discretionary corporate trustee, 316 plan administrator, and we've brought in an outside 338 investment fiduciary to work in conjunction with our firm. The plan committee is made up of leadership from our adopting employers. It's a voluntary committee that meets once per year, and most committee members serve for 1 year. The annual plan committee attends the annual plan meeting, which is conducted in partnership between our firm and our Pentegra partner. This slide is now going to give you a sample pricing analysis that we ran for a client. It was based on a $5 million 401k plan with 100 participants. And you can see on the left, it shows the pricing structure of the current provider. In green, at 86 basis points, represented the cost associated with the investments inside the plan. It also covered record keeping and advisory support. And then in red, the 15 basis points represented the administrative fees for a total of 101. The select program came in about 15% lower, and you can see that we break out in more detail the investment. The orange represents record keeping and advisory support, and then the administrative fees. When compared to industry averages, coming in around 118 basis points, both of these plans obviously are doing better than the averages, but you can see that our pricing was more aggressive than the existing client's pricing. Now we're going to show you the pricing differential when we make the assumption that this plan is now doubled in size to $10 million in assets. You can see our current provider pricing is reduced slightly, but it's only due to the fact that the administrative fees were a fixed dollar amount. Thus, they become a smaller percentage of the overall cost. Plan comes in at a total of 94 basis points. However, you can look at our program. Our administrative fee also is a fixed dollar amount, and that obviously becomes a smaller percentage. But in the orange, you'll see that we also have a reduction in the advisory and record keeping fees. So now we're down to 68 basis points. When you compare that to industry averages on a $10 million plan at 114 basis points, you can see our pricing becomes extremely aggressive as plans grow. So what are the next steps? If you find this to be of interest, we would love to be able to run you a plan proposal and investment comparison report. What we'd like to do is we'd like to take our program and put it up against yours and show you the same kind of pricing analysis we just showed you, but also show you our investment menu in terms of performance and results versus yours. After reviewing that plan proposal, if you feel that our program is right for your organization, we have a fact finder / questionnaire that we'll have you complete. We'll need to get copies of some basic plan information and plan documents. We would then do a consultation to review your plan objectives. We would make recommendations on your plan design and talk about plan implementation. We would do a preparation and gather all the final documents that we need along with applications and so on. And then we would do a rollout of the new program to your employees in an education campaign. The transition where we're going to be working up the payroll contributions to the new provider, making the transfer of the funds and so on follows there. And then thereafter, we would put in place an ongoing service model that would be predetermined. You're going to know when you're going to hear from us and why you're going to hear from us at what time. And it's really about the review and the monitoring of the program. And then once we're complete, you're going to get to enjoy all the time that you've now found in terms of having to no longer spend that time on administrative functions and oversight of the plan, and also the peace of mind for knowing that you've outsourced so much of the day-to-day management and the liability of running your program. I'd like to thank you again for your attention. This is Steve Kuna, again, founding advisor of the Select Retirement Program. My contact information is here on the screen. If you'd like to get further information about the Select Retirement plans, you can go to the website. There's more details there. You can also schedule what we call a discovery call if you'd like to have a one-on-one conversation with us about the program. You also have the ability to request a proposal and also to schedule a proposal presentation date. So I encourage you to check that out. Again, thank you for your attention, and we hope to have the opportunity to assist you. Take care.